Welcome folks to Governance Training for CRCs. My name's Andrew Huffer and today I'm joined by the man of steel, John Denton. Welcome back, John.
Yes, good day Andrew, it's great to be here.
And today we have a special guest with us, Charles Sondergaard, who's a Chartered Accountant and Financial Strategist at Sondergaard Chartered Accountants. Welcome, Charles.
Welcome, and thanks for having me on the show.
Fantastic. Charles, I want to drill down a bit. Tell us a little bit about your background, please, and what you'll bring to the episode today.
Well, I've been in the public accounting area of business for about 24 years. We've dealt with a range of people from non-profits, small business, mining and oil and gas, expats, and I've been a board member on an education institution, one of the first higher education providers in Western Australia, the non-university higher education provider.
I'm really looking forward to having you on board today because today we're talking about financial management. So I think you're going to be able to add a lot to the topics we're covering today. And so we're now into episode 4 of the 10 episode program. And of course, there's still plenty of resources for you to get. You can log into the CRC portal, go to the Secure tab with your CRC details and grab the program workbook, which is listed there under the Governance tab. Remember, all the detail of the program is in the workbook, and it's worthwhile each week going back to that workbook and making sure that you're applying everything that's in there to develop your governance strategy for your CRC. Let's talk about what we've covered so far. Just to go back to last episode, in episode 3, one was looking at the use of policies, procedures and systems and how they all connected together. We looked at having a strategic approach, making sure that board members are looking at the big picture, where your board should be positioned in 5 years, and making sure you're working on that and incorporating that with your operational plans. So the operational plans are really that annual approach and making sure you're selling that operational plan to both your funders and to your end users. We also talked about the importance of contingency planning. So moving from plan A right through to plan G. So when things go wrong, you've got a way to back up and make sure that you can cover for anything that gets thrown at you, whether it be an IT issue or perhaps a staffing issue. And we finished up looking about the value of MSO, Management Support Online, what are all the resources in there and how they can assist you. Episode 4 today, going to be action-packed and full of value, starting off by talking about understanding your financial reports. So you have the opportunity to really delve down, look at the details of those and what they're actually going to be able to tell you about the future of your organisation. Similarly, we're looking at the value of budgeting so you can get a good understanding of what your budgets are telling you about how you should plan for the future and not to get too hung up on the past. We'll also look at opportunities for sourcing funds, how you can making sure that your organisation isn't too reliant on one source of funding and using that to become a self-sustaining CRC so that you can plan ahead and bringing sources of funding that can help you move forward with confidence rather than being worried about what may be cut or what may not be cut in a government funding budget. John, we've got a lot to cover today. Looking forward to you taking us off with Charles and getting into some of the details.
All right, thank you Andrew. Yes, we're going to start by talking about understanding the basics. And financial reports don't make necessarily the most exciting of reading, but what we're going to go through and what I'm going to discuss with Charles are some of the basics that appear in financial reports and how to interpret them and use them to drive your CRC. So the first decision that is usually made when it comes to accounting and setting up your books is whether you do your bookkeeping and accounting on a cash basis or an accrual basis. So Charles, can you explain to us what the difference is and why you would choose one over the other, please?
Thanks, John. The cash basis is more just a summary of the money in and the money out each month. It's generally appropriate for smaller organisations like clubs and sporting organisations. It may be appropriate for a very small CRC type organisation, but once you start employing staff and have assets and cars and have larger projects, the accruals basis is much better. The cash basis doesn't show your expenses not paid, so it would give you a misleading report on your actual monthly profit or loss. So the accruals basis actually takes into account bills not paid and monies not collected. So generally the accruals basis is much more appropriate.
Accrual really gives you a better opportunity to plan and forecast for your business, I guess, than a cash basis.
Yes, rather than just when the money is banked, it shows what you've actually earned or incurred.
Yeah, so you know what you've got coming up to pay out and
Yes, sir.
what income you've got coming up. And I guess with not-for-profits that are, you know, using government grants and things like that, then accrual is probably the only way to go.
And definitely, with a grant, you might receive 6 months' money up front. If you're on a cash basis, you might then show this as income in the month received. Meanwhile, that's got to cover the expenses for the next 6 months. So an accruals basis will allow you to then recognise that income over 6 months, not in the month banked.
Yeah, okay, that's great. So having made that decision, let's have a look at understanding financial reports, and we'll start with the income and expenditure statement, more easily pronounced as profit and loss. The definition I have here, Charles, is that it's basically a record of the money coming in and out of the business and what's left over.
In simple terms, you have your overhead component, which is your fixed monthly cost, and that will be shown in the overhead category. In your trading side of the accounts, you have your variable income coming in and your variable expenses going out, and generally in a commercial sense referred to as your gross profit. Now, your gross profit is what you have to earn to pay those overheads. If your gross profit is more than your monthly overheads, then you're effectively having a profit, or in a non-profit organisation having a surplus to carry forward to reserves.
So Charles, maybe we can have a look at a simple example just to explain this a little bit better. Every organisation, we hope, has an income coming in, and there will be some costs associated with deriving that income, and then what's left over is the gross profit. After that, we've got expenditure, which is the everyday running costs of the organisation, and then hopefully there is something left over after that, the surplus. One of the things that sometimes gets missed when looking at the costs associated with deriving the income are some of the overheads, an allocation of some of the overheads.
The first thing we'll look at is what it's costing us every month to run the organisation, and we'd refer these generally to these as our fixed costs. So you pay rent every month, you've got salary and wages, printing and stationery, electricity. So in this example here, we're spending $275,000 a year. Generally, those are evenly over the year, or certain expenses might be upfront. But if you have a look at that model there, we've round about got $25,000 a month fixed cost to run the organisation. Now, if you have a look on the income side, we've got income coming in. It's not necessarily even over the month. And then we have costs associated with that income. And that's also, those are variable costs against the income. So to earn that money, we have to spend specific money on those projects, and what is left is our $30,000. So that is giving us slightly more than the $25,000 odd a month overheads, leaving us with $30,000 profit at the end of the day. So if you have a look at that, we are making $2,500 profit a month.
Okay, so in terms of the direct cost, just to explain that a little more detail, if you were offering a printing service or something like that, then the costs associated with the income of doing the printing are obviously the paper and the toner and the wear and tear maintenance of the printing equipment and things like that. So they're direct costs that are associated with the income from doing the printing. And then the fixed expenditure is the costs you're going to have anyway.
Yes, whether you were running a printing business and whether you did printing or not, your costs that are fixed are the ones that stay in there. So if you've got some fixed wages for the staff working in that business, they're going out every month. However, when you do that printing job, you might be buying ink and buying paper, and that is then turned into printed material, so that ink and paper is a variable cost going under the cost of goods sold, and the amount they pay you for that printing job goes into the income.
So thank you, Charles. That explains that very nicely. The thing with profit and loss reports or income and expenditure statements, when they're presented to the board, I always recommend that you put on there the actual compared to budget. That's really key information for the board because it explains how the organisation is going against the forecast and the budget, so you know if you're on track. And the other thing is actual year to date compared to actual year to date for last year as well, which gives a good indication of how you're tracking against previous performance. And it's all about seeing if you're going off track or if you're still on track to keep doing what you need to be doing. And the cash flow forecast, we'll talk about some of these things in a little bit more detail in a moment. But first of all, I want to cover the other kind of financial report that gets presented to a board, and that's the statement of financial position or balance sheet. So Charles, this is I find balance sheets are things that a lot of board members look at but don't really understand. What is a balance sheet about?
John, the balance sheet summarises the assets and the liabilities of the business, and basically the amount the assets exceed the liability is the capital or the equity of the business. Now, key when trying to understand a balance sheet is to separate it into the current part of the business, which is your cash and collectibles and inventory, as opposed to the fixed part of the business, which might be buildings, plant and equipment, and long-term finance. So that's the first key item to understand. And that gives you a snapshot of what your business has at a point in time.
Okay, so put it simply in layman's terms, it's about assets minus liabilities equals net assets. That's how I think you're explaining it. And it's about what you own, what you owe, and what you've got left over. And then, again, terms that come up on balance sheets, which a lot of board members don't really understand, are things like current assets and fixed or non-current assets. What's the difference between those two, Charles?
Well, current assets are things that you will collect in the short term. So they include your bank account, which is cash ready now, and then your near cash, which might be monies owed to you, trade debtors or other monies coming in. It could also be grant monies held in a separate bank account. So anything that will be collectible in the next month or 6 months. Generally, we talk about collectible within 12 months for current, and anything that is only disposable or collectible in longer than 12 months, we call a fixed asset.
The next part is current liabilities and fixed liabilities. Similar sort of thing, Charles?
Yes, if we start with the fixed liabilities, everything else is current. So your fixed liabilities may be a long-term loan, which is funding that operation. So if someone lends you $100,000 repayable in 5 years' time, it's a bit like a home loan. The short-term part is what you've got to pay this year, and the long-term part is what you've got to pay in longer than 12 months. Now, your current liabilities are everything that you're paying on a monthly or quarterly basis. These might be the electricity bills that you've incurred this month and you're paying 30 days. They're also your insurances, payroll tax if it was applicable, superannuation that is payable on employees' wages, plus your trade creditors and other ongoing short-term bills.
Okay, that's great. That explains all of that. And it's great to have all the numbers and see the numbers presented to the board every month. But it's really now about, well, what are the numbers telling us? So Charles, let's have a look at a couple of things that we can derive from those numbers. And in accounting terms, they're called ratios. So we analyse the numbers and see what the ratios are telling us. And this is a fairly simple example that explains what we're talking about. So the cost of an employee or employees to the income for the organisation. As an example, a ratio of 40% means that 40 cents of every dollar of income is taken up by employee costs. And that's just an example that I've made up, so don't take the 40% as meaning anything particularly. But it's something that you need to know in a business or an organisation is what's the ratio of income to costs. Any comments on that, Charles?
Ratios give us an idea of whether our businesses are operating efficiently or not. One where an easy example is a restaurant. The key things they manage is their payroll costs, because it's a very labour intensive industry, and they don't want their labour costs to creep up if they set at 40% and they creep up to 50%, they'll basically chew up all your profit. Now the same when you look at your food cost. If your food cost is costing you 30% of your sales, imagine if your food cost goes up to 40% of your sales. That can amount to the profit in the business disappearing. So that's where you understand the ratios, and they start telling you when your operations are being inefficient or efficient.
The ratios can tell us how efficiently the business is working or the organisation's working. And employee costs, because they are usually such a big percentage of the total cost, is a key one to monitor. Another example I've got here is fundraising costs to fundraising income. And this is something that most not-for-profits do, is they raise funds and they have all kinds of events and fundraising activities. But what they need to look at, I believe, is the cost to raise some of those funds. So, for example, if an organisation raises $10,000 in income, but it's cost $9,000 to get that $10,000, then that's probably not a good ratio. You're spending too much money getting the income in. And if you know that, then you may not undertake that activity next time. Anything?
Yes, I think it's a question of focusing your resources. So your wages are a resource. And why would you put all that effort into an exercise of fundraising where it's a very expensive cost? If it's going to cost you 80% of that money to raise the money, wouldn't you put your resources into one which is a much better return on that wages cost? So if one fundraising event costs you 80% of the money raised, that's a lot of hard work to make the remaining 20%. If you could find others that were much more profitable with a much lower ratio, you're going to get a much bigger overall return for your organisation.
Yes, absolutely. And again, the example I've got there about 10%, if it only costs you $1 to raise $10, then it's a much better ratio. So when the board's planning their fundraising events for the year, then they should be looking at anticipating what some of the costs are going to be, so that they can focus their usually limited resources on the ones that are going to give the greatest return. Another key ratio for the not-for-profits as well is looking at their reserves versus their break-even or operating costs. Charles, how long could the organisation keep operating if their income stopped?
Yes, and John, I like the analogy where if a household didn't have any income coming in for 3 months, could they still keep paying the fixed costs, the mortgages and the bills? Now, a small business or a business organisation has to face those same things, especially where your income might be irregular, it doesn't come in evenly over the month. Now, getting back to those overheads we spoke about, and if that organisation was spending $25,000 a month, it has to generate a gross profit after fundraising or income earning activity costs of $25,000 a month to carry on. What happens if it had no income for 3 months? That means it needs to find $75,000 to keep the doors open. And that's where you look at, should I hold some money in the bank? Perhaps the $75,000 will keep the business open for 3 months, especially where we're working on a large project that then may make a big lump of income coming in the future. So that's where that contingency and cash flow planning comes in. Do we have enough in reserve to fund us through the bad times so that we're there in business for the good times?
Yes, thanks, Charles. And it's critical for a lot of the CRCs that are fairly reliant on one major stream of income or large streams of income. So just to sum up on the financials, some actions that I recommend: determine the key ratios for the CRC. So work out what the key measures are that you need to have in place. Agree an acceptable range for each ratio so that you can, on a monthly basis, have a look and see if those ratios are within the acceptable range. And report monthly to the board. So there should be a monthly report on the ratios and any variances from what's acceptable. Now I'm going to bring Andrew back into this to talk about one of his favourite topics, which is budgeting. Andrew.
Wonderful. Thanks, John. And this links quite well to the conversation we've just had and the importance of planning and moving it forward. And from a budgeting perspective, I guess for me, it's almost an analogy thinking for those of you who are into the wheat belt areas, is thinking about from a farming perspective when your dry periods are going to be, when you really actually need to have a reserve of feed on hand to be able to make sure that you can get through those dry periods. And so say if you're in the wheat belt, when you're going through to February, March, when you have that extended dry period, you need to have some good reserves of perhaps saltbush or some feed on hand to be able to make sure that your sheep are going to get through okay. And from a budgeting perspective, it's for me, in my business, the periods of December and January are usually the quiet periods in my consulting business. So I need to make sure there's plenty of money sitting there available for me to get me through that time. So I need to make sure that I've got my month-by-month budgeting in place and my annual budgeting in place and working well to get me through there. Some other things to think about in terms of budget planning is also to think about the 3-month approach to budget planning. And the month-by-month stuff's good, but the 3-month budget planning helps you to think about, well, what is the season going to be like ahead? If you think about, again, to farming, if you're coming into when you should be expecting the break around late April, early May, it's to be thinking about, okay, what information do I have on hand that's going to tell me that maybe we're going to have a dry period, maybe I'm not going to get that break of rain when I need it. And from a budget perspective, it's thinking about where could there be some lean times ahead, and how do I use some of the data I've got on hand to help me through that. And as a CRC, it's also being able to know what your break-even point is and when you're going to reach that. Charles, I'm just going to quickly throw to you just to give us a bit more detail on what a break-even point is for a business.
Okay, thanks. If we go back to the example John and I were talking to earlier on, is we said it costs us $25,000 a month to pay the rent, the wages and things like that. If we're not generating $25,000 a month, we can't meet those expenses. So that is your break-even level. If you have a look at that example, we needed to make a little bit extra so that we can put some away in the bank, and that's our profit. So the break-even is when we're just paying our bills. Above that is when we're making a profit. Now, that is the key thing to know for the future. And if I can just touch on your 3-month planning, is the break-even profit is not necessarily the cash flow, and that's why we look 3 months ahead to make sure the money's coming in as planned to meet those expenses. So there's a cash flow break-even and there's a profit break-even, which could be a little bit different.
Thanks for that. And as John and Charles pointed out earlier, it's important to be really clear on what reserves we have in place so we can bring in to make sure we're able to keep operating in those drier times. I think it's also worth just coming back to a quote of John's, which really helps bring it all together for me, is use your cash flow planning your quote is, don't tell us that we've had a terrible month.
Tell us we're going to have one.
So you can use this as a predictive tool rather than just looking backwards all the time and say, oh, geez, that was terrible, that was terrible, that was terrible.
Yeah, so a lot of boards, from my experience, spend time analysing the numbers in the reports as, it's what's happened, it's history, and you can't change history. So the focus really needs to shift on to talking about what's going to happen. So don't tell me we've had a bad month, tell me we've got one coming up so that we can plan and organise around it.
Yep. And Charles, I know you really recommend to a lot of your clients that it's about planning quarterly, really being quite clear that every quarter ahead you know what's coming at you, and so you can get ready for it, just like John mentioned in his quote there.
People stick on a 30th of June calendar budget, and so they start drafting this budget in July, which gives them about 11 months left to sort of plan ahead. As they creep closer to the 30th of June, their time frame drops down, and now when they get to May, they've only got a 1-month plan ahead of them. If you work on a quarterly basis and you do at least 4 quarters planning ahead, when you get to the 30th of September, you should now add on 3 months onto your budget and drop off the September that you've seen. Have a look at your September quarter that you've just compared against, see where that's going, and now add on a quarter so that you're actually always 12 months planning ahead, not on a shrinking budget. That allows you a much better way of planning for the future use the past to judge to set those plans for the future.
So it sounds to me like that way you're never going to get caught standing still. You're always on the move, looking forward and anticipating what's coming up, so you're ready for it.
Yes, definitely. Budgeting is not an annual event. It is a quarterly event, and it's always looking at least 12 months. If you want to be a little bit further than that, look 18 months ahead and continually add one quarter on as you drop off one quarter. Now you know where your business is going.
Fantastic. I think that's really good advice to just really reinforce that quarterly approach to your planning, both from a strategic planning perspective and also this budget planning perspective. I want to touch briefly now, just moving forward on fundraising, and John and Charles already talked about. The key message for me is to make sure there's somebody with a responsibility to undertake fundraising in your CRC. So having a committee established, making sure there's clear goals and timelines about what's going to happen and when, having some strategies in place of what we are going to do, and importantly, I think Charles talked about earlier, what we're going to avoid doing, things that are going to cost us a lot but aren't really going to deliver much. And it's always about where the buck stops, literally in this case, of making somebody responsible to keep that fundraising happening in your CRC to make sure it becomes a reality for you rather than wouldn't it be good if. So taking that forward, I think it's worthwhile also having the discussion about making your CRC self-sustaining and what are the opportunities there. And firstly, I want you to think of two numbers for your CRC that are numbers of evil. And that is number one, which is never rely on just one source of funding. That is never do that. Because if that goes, it's game over pretty much. The other one is number 15. Believe it or not, 15. 15 is an important number because you should try and avoid having more than 15% of your revenue come from the one source. So that way you spread your risk by having multiple sources of income. So I want to go into that in a bit more detail now to look at becoming self-sustaining. So multiple sources of income are probably one of the critical things for any business or CRC to make sure that you become self-sustaining in the future. So a couple of those streams. Let's talk about what those streams could be. So we've talked a bit about funding options. Grants and donations are another one. And also, I know a lot of CRCs have membership bases where people pay an annual membership. And to me, I think that's a great way of bringing in ongoing funding streams. And I think it's a great opportunity to add value. So I think that's one of the opportunities. I reckon CRCs could really ramp that up a bit more. I think a lot add in your base level membership. I think you could add some value adds to make that membership move from what I call the bronze level through to the silver and gold membership, so people get the special rights and privileges that other people don't get. John, you've had a lot to do with membership-based organisations.
Sure, yeah. It's about finding out what the community wants and what are some of the attractions for them in the CRC and building up that value add. And then, as you say, you're offering different levels of membership so that people automatically get certain access to, like, web facilities or training and so on. So I know one large membership-based organisation that offer training in return for the membership. So depending on what level of membership you're at, you get different access to different levels of training automatically. And there's lots of things you can build into that. It's about being creative.
In terms of membership, if you really want to just increase your membership income straight away, it's create, like John referred to, that second level of membership. And where it really works is if you have your bronze, your silver and your gold membership, most times people will go for that silver, that in between. So you can increase the membership price that way and guarantee that probably 50% are going to go for the silver membership, therefore increasing your income straight away. And people like to feel a bit superior than others by having silver membership as opposed
Nobody
to
wants the basic level membership. No.
boring schmoring, that's for sure. The other opportunities for becoming self-sustaining are thinking about the partnerships and joint ventures. Who can you work with where you can perhaps bring in other resources that a partner organisation already has access to? How could they help you in terms of the resources they can provide to you? And thinking about opportunities like some pro bono work. So you might be like working with your local maybe accountant, Charles, or perhaps working with your local legal business where they can provide you with some services in return for good exposure for their business. So keep thinking about where those opportunities are available. They may even exist through current government agencies. They may give you access to resources that you previously had to pay for. And the other part in becoming self-sustaining, and Charles and John have already referred to those, looking at your events, perhaps training options and some of the workshops that you're running, and making sure they're providing a good income stream to balance off and provide something that's going to take you forward and give you probably a strong reputation. If you've got one event that really works well for you, then that can be something that you're going to get people from right across the region turning up to you, and you get known about. And once you get known for something, I think it gives you the chance to really ramp it up and pay some more for. And I've been working with a client over in another state called Victoria, I think it is, and they run this great event every year called Chicks in the Sticks. So it's focused on regional women. They get them together for a day. They shell out $100 to $150, no questions asked, and they have some guest speakers along, and it's a really good event, and they sell it out literally within 1 or 2 days because they know their target audience, they know what they want, and it's become an event where people are saying, I'm going to be there, I'm putting it in the calendar, and the organisation that puts it on are really having to push people back, saying doors are closed, can't fit any more in. And that to me is a great example of how they've spread their risk by getting an event like that, which becomes a showcase event for them to get people in.
Yes, and when looking at some of these events and activities to run, think about what people need for the particular community. So in marketing terms, we say identify the pain and then address the pain, and it's the same in these communities. What are people missing out on? What sort of services and things is it difficult to get, and then find a way to provide those things on an economic basis for people. With the agency thing, like shire payments, paying rates and things, sometimes people can have to travel a long way to do that, but if the shire services are provided by the CRC, then people can get it on the spot. So think about what people are missing out on, what sort of pain they're going through, what their needs are, and then address some of those with services or events or training or workshops.
And Charles, you strike me up as a bit of a pin-up boy. I want to hear about your calendar.
Yes, thank you. I've been sitting here waiting to get this out. We talked about quarterly planning and 12-month planning and 18-month planning ahead. One thing I find for a CRC that would make a lot of sense, we talked about income streams and when things happen. Now, let's just say in the last quarter we've held this Chicks in the Sticks event. It's our quarterly function, and let's say it happens in every May. Who's planning for it next year? So if we had a monthly or quarterly calendar, again, when we do that quarterly budget update, we should be looking ahead and updating our corporate calendar. This is a calendar of events and other critical functions in there. So we look at the last quarter and say, are we going to do that again in 12 months' time? And review your next 12 months ahead. So you can have a corporate calendar running from July through to June for this next 12 months. When you've finished a quarter, now plan that quarter ahead for the next one. Put someone in charge of running the Chicks in the Sticks event. What do we do in January? What do we do in February? What do we do in March? So that you're looking ahead 12 months, and this corporate calendar becomes an integral part of your income streams, your budgeting, your planning ahead. When you apply for your grants each year, perhaps it's a May thing where grants are applied for. Log that in. Every May we apply for our corporate grant or government grant. When do we run different things that might be seasonal or functional? So there's my corporate calendar. You can put it next to the fireman's calendar, but it's a critical part of your business.
Fantastic. Thanks, Charles. And I think that's a really good advice. It's a fantastic tool, and especially for organised CRCs where you've got perhaps if there's new staff coming in, it's a great way for them to understand what happens here and the things we need to plan for to make this CRC a sustainable one as well. I think it's been a really good episode. And I'd just like to sum up quickly now some of the things we've gone through just to reinforce that for us in terms of the importance of financial planning. We've had the opportunity to really get a clear picture on what the numbers are telling us. So not just to read a report and accept it for what it is, but to actually ask some good questions to get an understanding of what those numbers are telling us and how they can inform the future planning of our CRC. We've also talked about the importance of budget and cash flow projections and how they can be used as a tool for planning and making sure that we've got a sustainable business going forward. And as John always mentions, a good board member is somebody that asks good questions. So within all these activities, it's important to question what have been some of the changes, why have they popped up, why has this been different to last year or last quarter, and what should we be doing now to make a change. We've also recommended having people that are responsible for your finances. So setting up that finance subcommittee will help bring better questions and making sure that you really got a robust approach to managing your finances. We talked about allocating responsibility for fundraising and making sure that you're really working as a CRC to become self-sustaining. So you're not just reliant on government funding, that there's a whole host of opportunities that you're offsetting your risk by making sure that you've got multiple income streams to take you forward over the next 3 and 5 years. Remember, MSO has heaps of fantastic resources for CRCs. Here are just a few that we recommend that are most relevant to today's episode. So that's pretty much it from us. I really encourage you to go back to the workbook and look at the 3 things that you want to address and put into place from this episode. So I'm looking forward to joining you on episode 5 when we're looking at managing priorities. Thanks, Charles, today for the expertise that you brought to this episode and the time and effort you've put in.
Thank you, Andrew. It's been great here, and thank you, John.
And thanks, John, again for your strategic direction and the way you keep adding value to every single episode we bring here.
Always a pleasure, Andrew. It was a very meaty episode, a lot of information in this one. And I'm really looking forward to the next episode.
So make sure you recap, go back and look through everything in this episode and apply it. And we'll see you next time in episode 5. Thanks, folks.